Okay, in this tutorial, I'll be going through a stock which has symbol X and CR, and I'll just show you I'll just scan through it, and I'll just copy that and I'll paste it in Google and write in stock. And if you can see on the left hand side, there is stock information from Google, and on the right hand side, the information is from Wikipedia, hopefully. And let's see. So you can just see the name of the stock, which is Xencor, I think, company. And if I want to buy it right now, I have to pay 40.93 US dollars to buy one stock right now. Okay. And if I want to know when was this formed, I can just see founded, and it's 1997. Okay. So it's an old firm. And I'll explain you the sector later on in the video. Now I want to concentrate on four ratios. The best website that I like for ratios is Macrotrend, and you can just type it in Google, macrotrend.net, and just go to price ratios and price book ratio, and type in this the symbol of the stock or the name of the firm, and make sure that the symbol and the firm matches. So it's exactly the same, because some stocks have the same symbol, so in case you get mistaken. So price book ratio should be 1 or below that, for it to be, if it's below 1, then it's a good bargain for you to buy. It's very cheap stock. And if it's 1, that's still very good, because it means that you're paying the same price for the book value. So the stock that you're buying is exactly what it should cost. So you're not paying too much price for it, or it's not expensive, it's the same price. But if it's more than 1, the ratio is more than 1, it means that the stock is, you're paying more than what you should be paying for it. So let's see. Right now it's 3.78, which means that the stock is 3.78 times more expensive to buy right now. So you'll be paying a lot of price for it. But if I just go back, and it was 2.87, which means that people who bought in March 2019 paid 2.87 times more price for the same thing. But people who will be buying now, they'll be paying 3.78 times more price. And if I just go back and let's see when the price was the lowest, I think it's in 2015, September, that it was, people were paying 3.2823 times. But I think the lowest was in March 2019, because if you just see that the book value is $10.82, which is the cost. But to buy that, people are paying the market price for the $10.82 is $31, which is quite expensive. But this stock has been cheapest in March 2019. It has been most expensive in 2014 December, when people were paying for $1.89, they paid $16.04. It was 8.5 times more expensive. So you need to make sure that the lowest the ratio, the better. And if it's below 1, then it means you're getting a discount on the stock. You're getting it very cheap. And if it's 1, then it means that you're paying the same price as the book value. But if it's more than 1, then it's very expensive. And let's see at other ratios. And the current ratio should be 1.5 or more than that for it to have a good margin of safety. If it's 1, that means the assets and liabilities are same, which is good. But if it's 1.5, then that means that the assets are quite more than liabilities. So there's a lot of margin of safety. The stock is quite secure. So let's see if it is. Okay, so right now it's 6.67, which means that the assets are quite a lot more than liabilities, which is very secure. So if I look, the liabilities are 0.07 billion, but the assets are 0.49 billion, which is quite a lot. So there's a lot of safety. If I just go back, it's 5.86, then 5.52. So it has been throughout, no, just in March 2017, it has been 1.5 or more than that. But if I just go before that, it's 1.33, that's below 1.5. But still, The assets are more than liabilities because it's more than 1. So it's 1.33. Let's go back. Okay, right now in 2016, you can see that the assets and liabilities are same, 0.11 billion both. So it's 1, which means that it's there's no margin of safety, the stock, but it's equal. If I go back, it's 2.1, which is greater than 1.5, and I just go back, it has been greater than 1.5 throughout, and that's 1.25 and 0.56. Okay, in 2011 it was 0.56, which means that the liabilities were more than the assets, so it was very not secure to buy this. There was no margin of safety. You can have a look that the liabilities were 0.03 but assets were 0.02, so assets were less than liabilities, which is scary. But overall it has been quite just once I think it has been 1. After that, it has been 1, which is equivalent to assets and liabilities, but then straight away it has been above 1. So, you know, it's not too bad. It's not doing too bad in terms of that. Only when in 2011 it has been very not secure, but then it's doing very good. If I go to debt equity ratio, this will tell me if the company is mainly operating on debt or equity. If it's operating mainly on equity, then it's good for the firm. If it's operating mainly on debt, then it's not. There's no margin of safety. So it's very risky to invest in there. So it should be zero point 0.5 or less than that for it to have a good margin of safety. Let's have a look. Right now it's 0.02, which means that company is mainly operating on equity. So zero point zero 0.02 is very secure. It makes there's a lot of margin of safety. So this is doing very good. 0.61 is the equity, zero point zero 0.01 is the long-term debt. So, and then it has just taken the debt. So previously it hasn't taken any debt. It was operating fully on equity, which is very good for the firm. But just now it has taken debt, but that debt is very little compared to the equity. It's the ratio is a lot less than zero point 0.5, so which is really good. So it's very good in terms of margin of safety. If I click return on equity, it should be 8% or more than that for it to be having a margin of safety. And let's have a look. So we don't have any data for that for previous years. Maybe you can search it in another website, you might get it. So I'm just doing it from this website, so it doesn't have any data, previous data, but it says that on 31st March, it has 7.717% return on equity, which is good, but it should be 8% or more than that for it to be very secure, for it to have a good margin of safety. But 7% means that it's a good return, but I am not sure, like, because I need to know the previous returns as well, so that I need to know maybe it was returning 1% previously and now it's 7%, so which is not good. If there's a consistency in return previously of being 8% or more than that, then it might be good. So I don't have the previous data, so I can just search it somewhere else about that. And then if I just look in Google to see if this stock pays any dividend, it doesn't pay any dividend. The dividend yield means not applicable, so it is not paying dividend, which means that if a company is not paying a dividend, it could be that it's not financially that good that it can pay extra money to its shareholders, because dividends are extra money that the company don't need, and they have already invested the money that they generated, but still they have extra money left, so they give that to shareholders as dividends. So it might not be it might be that they are not able to generate extra money that they can distribute to the shareholders, so they don't have any dividend. If I look at the cap and I want to know if the firm is big or small in billions or millions, I can just look from Google. It's 2.31 billion, which is a big firm. If I want to see the reviews of people working there, I can just I can just select the firm. I can go to Indeed, which, okay, so I have Glassdoor actually here. Let's go to Glassdoor first. And so I can see I can see I can see the 4 stars. I can see the 4 stars is given, and there's only one review, so I'm not sure if I can rely on one review. But you need to be careful about that. The reviews are very less. And let's look at Indeed. I'll just go to reviews, and I'll click Indeed, and let's see. I don't think it has anything in Indeed. Maybe. No, it does. If I click here, can I get company reviews? If I click on company reviews and then find companies and reviews, no, it doesn't have any review. Nobody has given review yet. They have 7 jobs advertised, but they don't have any reviews. So there's just one review in Glassdoor. So it might not be enough to you know tell a lot. So Justify and Justia Patents, that's a website for patents. It's good to see if some firm has a patent. You just type in the in search bar the name and click enter. And I'm just interested in and applicant and assignee, because these are people who have the full rights of the stock. I'm not interested in inventors, because these are people that have invented it, but they don't have the rights of the patents. So just applicant assignee. So I'm just looking at it, and in 2012 they filed a patent, then November, then October, then April 2013, April 2013, March 2013, 2005, 2005, and they have a lot of patents. And what I'm more interested in is that the more patents they have, the more strong moat they will have. So the more competitive edge they have, because they have patents, so they have rights, so that they have competitive edge that their competitors don't have. So the more patents, the more better for the firm. And so it means they're continuously innovating, and that's in 2011. So what I'm more interested in is that if they are innovating, or if they have patents in recent years as well. So they do in 2015 14, so it means they're continuously innovating. It's not that they have just innovated at start and now they're not doing anything, which is bad. But I can see the recent patents in 2016. So that's what interests me. Which is, so it means they have a lot of patents and they have recent patents, which is very good for the firm. And lastly, I'll go to Yahoo Finance to see the salaries of key executives. So what are the salaries of key executives? That is very important to me. I'll just search on the search bar and make sure the symbol matches with the company name. And I will go to the profile. And if I have a look, the sector is healthcare. This is from where you get the sector. So it's in healthcare industries, biotechnology, and the full-time employees are 156. They have just, these are key executives, so the main people of the firm, and these are the names. And I can see that only 4 of them have shown their full salaries, but only one person, the salary has not been shown. So I can search on that. Maybe this website hasn't covered that, and they have shown it in another website. So I need to search on that, because the more transparent it is, the better. And so you can also go through it. You can go to conversations, you can have a look and stuff like that.